the ultimate beginner's guide to cryptocurrencies. We're going to cover Bitcoin, how Bitcoin and cryptos work, altcoins, types of crypto investing, crypto terminology, crypto myths, how to buy crypto, cryptos you may want to buy, portfolio examples, and a whole lot more. So let's go ahead and jump right in. So our current banking system isn't great, and we didn't fully realize how bad it was until we got a taste of something 10 times better. Bitcoin.
The hottest currency in the world, the Bitcoin.
Bitcoin.
Did anyone read that article about Bitcoin I sent you?
Before Bitcoin, it wasn't possible to make electronic payments to someone without the help of a third party, which is expensive and slow, especially when sending payments to another country. And then add in the fact that banks and payment processors have access to user data and will sometimes even sell this data for their own benefit. And these systems still exist today. I mean, we have some front-end systems like Venmo to make small transactions that seem instant, but there is a ton going on behind the scenes. And that is exactly why 13 years ago today, Satoshi Nakamoto created the idea of Bitcoin, a new secure digital currency system that provides true peer-to-peer transactions from anywhere in the world. No third parties, no middlemen, low fees, and totally decentralized. A currency run by the people, for the people. A lot of people view the creation of Bitcoin as the start of democratization of finance, giving power back to the people. And then 13 years later, the concept of Bitcoin has proven to work well, and people are realizing its potential, and this is why we're seeing the crazy increase in price of Bitcoin year over year. Now let's talk about the blockchain. We know what Bitcoin is. Next is how exactly it works. This will be the most technical section of this video, but you can handle it. We'll break it down piece by piece. So the technology behind Bitcoin and cryptocurrencies is called blockchain. Blockchain, put simply, is a public, verifiable, and tamper-proof ledger of transactions. Breaking this down, public means anyone can look at the transactions. Verifiable means you can compare the transactions with others to make sure it looks accurate. Tamper-proof means, well, there's no funny business. This is because there are so many copies of the transactions that you just can't get away with changing one copy. You'll be caught. And a ledger of transactions is quite literally a list of all the transactions. If you buy Bitcoin, that transaction is added to the list and it is kept there forever. That's how the system works. So here's an analogy to kind of piece this together and visualize how it works a little bit better. So imagine you and two friends are working on a paper in Google Docs. You can all see the doc at any time, and you can also see the full history of changes. So if one friend adds a good sentence in there, you can see that he added it. Great, this helps out the paper. If another friend adds an incorrect sentence, you can also see this. It allows you to say, hey, that sentence is wrong. We gotta get that sentence out of here. This allows you three to come up with an agreement, also known as a consensus, as to how the paper should look. It prevents any funny business and is totally transparent. That's the general idea of how it works. Now, why do they call it a blockchain? As transactions are completed, they're added to the public ledger. And that ledger is stored in blocks of data. Now you can think of each block of data as a little house that fills with data, and we'll visualize the data in the house as furniture. Each house stores three things. So it first stores the transaction data, which is the furniture. It also has an address so you know which house is which, and it has the address of the neighbor. So imagine each house has a sign outside pointing at the neighbor, and on that sign is the neighbor's address. And here is where it gets really secure and really cool. So a house's address is determined by its contents. So imagine if you moved some of the furniture around inside the house, the furniture being data, the address of the house changes. Now what this does is alert your neighbor that something has changed, because remember, the neighbor knows your old address. This prevents tampering from happening. Your neighbor knows that the furniture moved. Your neighbor knows that the data changed. So if data in the block is changed, neighbors are alerted and the system knows there is an issue and they can kick out that issue. Now, who puts the data in these blocks? This is done by a network of nodes, which are basically computer programs that crypto miners run. You can think of crypto miners as like the maintenance crew and the security in our little blockchain neighborhood. You know, those houses full of data, they're maintenance and security. They're building new houses and they're making sure everyone's address is still correct. Now, I know that this might be a little bit overwhelming, but don't feel bad if you need to watch that section a couple times just to really understand it. But realistically, you don't have to completely understand it. All you need to know is that the network Bitcoin exists on is virtually unhackable, completely transparent, and no one has control over it. Now, the reason I say virtually unhackable is because it's technically possible, but it would require someone to convince 51% of all Bitcoin miners to join in this evil scheme. And if they did join, they would lose money. So it's very unlikely to happen. Over the course of the last 13 years, Bitcoin has gone from a fraction of a cent to $60,000 per coin and everywhere in between. And in that time, many other projects have emerged, all hoping to use blockchain technology for better and better uses. The new coins that have popped up are referred to as altcoins. Now, one of the first to really take advantage of blockchain technology for more than just a currency was Ethereum. Now, I could do an entire video just for Ethereum's use cases, but the major difference is that Ethereum's network also has tokens that are completely programmable. So instead of just being a currency, it can be anything else, including images and videos, also known as NFTs, contracts called smart contracts, and much, much more. And innovation in blockchains did not stop there. Projects have been popping up like crazy, all of which use blockchain technology in new and creative ways. So one example here is VeChain. VeChain is a blockchain network that aims to help track and maintain real-world goods in supply chains. There are perfect real-world use cases for cryptocurrencies that are being explored as we speak. Now let's talk about crypto investing, the fun part. Bitcoin and all of these altcoins fluctuate in price like no tomorrow. I mean, crypto's prices could swing 8% in 60 seconds and no one would think twice about it. This ain't your dad's S&P 500, let me tell you that. But of course, this has attracted investors looking to diversify, as well as Wall Street bets apes looking to YOLO their life savings into an altcoin. There really are two investors in crypto. And if you're watching this, I think it's really important to decide which type of investor you're aiming to be before you plan on investing, and to have a plan first. So the first type is a hodler. This is the type of person who's in it for the long run. You invest in projects that you feel like have strong underlying value, and regardless of price swings, you don't plan on selling in the near future because you feel like that project will be worth significantly more in the long run.
You had a balance of 93 cents, and at an average of 2.25% interest over a period of 1,000 years, that comes to $4.3 billion.
Now, this type of project typically stays away from small projects or at least minimizes exposure to them. And the second type is a swing trader. This is someone who's looking to cash in on those 8% swings that I mentioned earlier. Someone who speculates on the short-term price movements of a crypto in order to make a fast return on their money in exchange for, occasional losses. No matter your investing style, I think it's always good to learn more and to have a community around you. And if you're looking to learn even more, you'll want to check out my Patreon that's linked in the description. In there, you're going to find a ton of stuff. You're going to find private content, live coaching, my thoughts on the market, my buy alerts, and a private group of dedicated investors. Now, we only open a few spots at a time, so you'll want to make sure you grab one of those spots before they sell out again if you are interested. And now let's talk about crypto terminology to help you better understand any future YouTube videos or articles that you come across or sound a little bit smarter at work.
I understood that reference.
So we're going to rapid fire some words and brief definitions, so feel free to watch this section a couple times if you really want to get them to stick, because I know I've spent a long time just learning these words and be able to rattle them off like this. So we're going to start with a couple refreshers. First off is altcoin. This is any cryptocurrency besides Bitcoin, an alternative option to Bitcoin. Then we have blockchain, a secure and decentralized ledger system. This is the technology behind most cryptocurrency networks. Fiat, a currency that's backed by a government and not backed by a commodity like gold. The US dollar is a fiat currency. Crypto address. This is a destination for a cryptocurrency being sent. It's really no different than when you mail something with the post office and you write an address on it and the mail goes to that address, except it's with crypto. Exchange. An exchange, or more specifically, a crypto exchange, is somewhere where you can exchange one crypto for another, or exchange fiat for crypto. There are centralized exchanges like Coinbase, and there are decentralized exchanges like Uniswap. And decentralized exchanges are not controlled by any one entity, unlike centralized exchanges. And then we have dApps. It's an app, but it's decentralized. Hence the D. This is any application that runs on a network that is decentralized. All applications running on Ethereum are dApps. DeFi. This is finance, but decentralized. Just as simple as dApps, it's a blanket term for anything financial that is the decentralized alternative to traditional finance. So getting a crypto loan would be considered DeFi. Next up, gas fees. This is a small fee, well, depending on the network, small fee that you pay to a network for sending crypto to a specific address. This is an important part of crypto systems because it prevents spammers and helps to uphold the network. Then we have mining. Mining is a process where computers solve complicated math problems called hash problems in order to earn the right to verify new transactions on a network and be paid in that network's currency. And then we have staking. Staking is essentially where you lock up your cryptocurrency to help facilitate the network, and you're paid back that cryptocurrency as passive income in return. Then we have hard fork. This is when a significant change is made to a crypto, kind of like a software update. In some cases, a crypto forks into two separate currencies, a new version and an old version. Well, most of the time this doesn't happen. There have been instances where the previous version remained due to disagreements, and a new version crops up. Bitcoin Cash is an example of this. It's a product of a Bitcoin hard fork that created Bitcoin and Bitcoin Cash. And then we have smart contracts. This is the core feature that makes Ethereum so great. It's like a legal contract, but it's digital. It's created, managed, and executed by the network. No middleman is involved, and it is amazing. And then we have market cap. This is the total value of all coins in circulation put together of a specific cryptocurrency. This is helpful in determining the value of a crypto project as a whole compared to another. Remember, the price of a coin doesn't matter. The market cap does. Always look at the market cap when you're comparing cryptocurrencies. And then we have whale. This is someone who owns a notable chunk of one crypto. A whale is really anyone with enough of one crypto to move the price when either buying or selling. Now that you know the terminology, let's talk about crypto myths that you may have heard of before, and we can address them head on. The first myth, crypto is a bubble.
Patrick?
Yes, SpongeBob?
I don't think this bubble can get much bigger.
Nonsense!
And this isn't necessarily true or false. Some think that crypto is just one big joke and it's this huge speculative trading bubble of people moving money around that's bound to collapse any day now. Others think cryptocurrencies will be used for literally everything. But the reality is, it's likely somewhere in the middle. Projects like Ethereum have actual real-world value. But it's still very hard to determine how much these projects should be worth. It's hard to determine if they are overvalued or not. The second myth, crypto is just gambling. Well, there's no denying that crypto is highly speculative. The reality is that a lot of crypto projects have or aim to have real-world value. Third, governments can just ban crypto and then it's going to go to zero. So yes, there are governments who just simply dislike cryptocurrencies due to criminals taking advantage of the anonymous nature of crypto networks. But at the end of the day, governments don't really have much control over the currencies themselves.
But here I come, the government.
So while they can do everything in their power to prevent people from using fiat to buy crypto, it will continue to exist. And plus, there will always be certain countries who embrace crypto totally and will benefit from that, and that will kind of peer pressure other countries into accepting it. And fourth, cryptocurrencies are just like the US dollar and can be used to buy everyday stuff. Now, hopefully one day. Unfortunately, in most cases, you can't just go to the grocery store and buy your groceries with Bitcoin. And while this might happen one day, we still have a long road ahead of us and a whole lot more regulation that would need to happen for cryptos to be used every single day like the US dollar. And then the fifth and final myth, cryptocurrency is just for criminals. Okay. Criminals do love crypto because they get to stay away from banks watched by the government. But that doesn't mean it only helps criminals. I mean, put it this way. I bet murderers loved when knives were invented, but I'm pretty sure knives can be used in a few other ways besides, stabbing someone in a murder. Let's talk about how you can buy crypto. Now that you're all caught up to speed, you're a crypto expert, if you will, we need to actually get some crypto in your wallet. You have two options here. You have centralized exchanges or you have decentralized exchanges, aka DEXs. If you are brand new, you should definitely stick to centralized exchanges. They are much easier to use. So here are two centralized crypto options that I personally use. First one, you've probably heard of it, is Coinbase. Coinbase is the most popular exchange for beginners and for a good reason. They offer a really easy to use and intuitive UI, an easy to use app, and many fiat options. Now, the one big downside though is they have high fees. But despite their high fees, if you're brand new to crypto and everything in this video is new to you, I would still highly recommend going with Coinbase and not worrying about the next option, just until you get used to crypto in general. But the second option, the one that I primarily use, is KuCoin. KuCoin is great for your all-around crypto needs. They have extremely low fees and a vast selection of altcoins that you can buy, stake, lend. You have far more options. Although no exchange is perfect. First, there's a much higher learning curve. It is far harder to use than Coinbase. And second, they don't support fiat transfer. So in order to get money onto KuCoin, you actually need to use another exchange like Coinbase to first buy crypto and then transfer it over to KuCoin. So KuCoin paired with Coinbase is a pretty awesome option. That's what I do personally. And I have a KuCoin tutorial that I'll pin above that shows how to do all of this. But again, if you are brand new to crypto, don't worry about KuCoin, just use Coinbase. It's super easy to use. Both those options will be linked down in the description. So you're all set up and ready, and assuming you want to make money, what you should buy should really be based on your risk tolerance. Bitcoin and Ethereum are considered lower risk options when it comes to crypto, and beginners generally should stick to buying those two until you're more familiar with everything else. Bitcoin is a store of value for millions of people and companies, and it's unlikely to disappear. Ethereum is the backbone of thousands of blockchain projects, and that's unlikely to go anywhere anytime soon as well. So if you're looking to invest in crypto, but you want as little risk as possible, Bitcoin and Ethereum are the way to go. However, it's worth noting, despite being lower risk in the long term, they still can fluctuate pretty heavily on a day-to-day basis. Now let's say you're willing to take on a little bit more risk and you want to put your money in more than just Bitcoin and Ethereum. Well, you're in luck because I have many videos on my channel diving deep into various crypto projects like Cardano, Solana, Chainlink, VeChain, and many, many more. I will link a playlist in the description so you can check out all those projects and feel out which one you believe has the most potential. But always make sure to do your own research before buying anything. Never buy a cryptocurrency just because someone tells you to.
Let me see your identification.
You don't need to see his identification.
We don't need to see his identification.
Now let's look at 4 portfolio examples. That way you have an idea of potential options for your crypto portfolio. The first one we're going to call Bithereum. You don't want to learn much about crypto. You want fairly low risk, 50-50 Bitcoin and Ethereum it is. This is probably the lowest risk crypto portfolio, but again, that's low risk. Long term, there can still be heavy day-to-day price fluctuations. The second one, we're calling this I dabble in crypto. This is a majority Bitcoin and Ethereum for the lower risk and a small portion in larger altcoins like Cardano, DOT, and Chainlink. The third portfolio, we're going to call this Mr. Balanced. A balance of all the top cryptos weighted slightly towards larger projects with lower risk. This is a popular portfolio for those who want some of the potential upsides of smaller altcoins, but still want to stay fairly grounded in terms of risk. And the fourth and final portfolio here, we're going to call this Altcoin Gore. So this is a little bit of everything with very little regard to risk. Honestly, if you're new to crypto, stay away from doing this method. Something like this, it's not exactly a horrible idea because it does have upside, but it will most likely require a lot of work, a lot of rebalancing, keeping up with the news, and has far, far, far more risk. Now let's talk dollar cost averaging. Due to the volatility of crypto, it's probably not the best idea to go and just throw all your cash into crypto all at once. If you buy all at once, you might end up buying at a peak or at an inopportune time or at a higher price than you want to. So a good option to avoid this is dollar cost averaging. This is where you slowly buy in over time, over the course of days, weeks, or even months, depending on how much you have to invest. This averages out your buy-in price, so you're not buying on peaks or on valleys. So it prevents you from getting super lucky, but also prevents you from getting super unlucky. You're hedging your bets. Put it this way. Would you rather flip a coin before you eat to see if the meal is going to cost you $10 or $30, or would you rather just pay $20 every single time? Dollar cost averaging is paying $20 every single time. So an example of this with crypto could be something like buying $100 in Bitcoin once per week for 10 weeks rather than buying $1,000 in Bitcoin all at once. All right. One last time, let's quickly remind ourselves of the risks of crypto before we completely jump in. So first off, again, crypto is very volatile. Don't invest money that you need in the near future. And number two is hacking. So cryptos are still a very new technology, and while larger projects and exchanges are very secure, smaller cryptocurrencies and smaller exchanges can be vulnerable to hacking, which of course we need to consider as a risk. And then third is human error. Mistakes can and do happen all the time, like sending crypto to the wrong address or losing certain security passphrases. The thing about crypto, it's not reversible. There's no customer service for you to call. So don't be afraid to double check everything, watch tutorials on everything that you're unsure of. Don't be afraid to do that. You're doing it already, so you're already ahead of the game. And that's gonna do it for your introduction to cryptocurrencies. From here, my recommendation is to simply learn as much as you possibly can. Watch videos, read articles, and if you like my style, consider joining my Patreon for additional content that will be linked down below. I would like to thank you so much for watching. Like this video if you enjoyed it, and I hope you have a profitable day.